Typical structure of a project financing debt transaction. We will now focus on how to structure a project financing transaction, particularly from a senior debt perspective. Senior debt tends to be undertaken by the lenders with the lowest risk appetite in the capital structure. For this reason, the risk mitigation mechanisms senior debt lenders put in place tend to be the most comprehensive of all funders within a capital structure. It is therefore useful for us to look at senior debt in greater detail and use it as a departure point when later analyzing other funding sources for project financing. Structural and contractual subordination. It is important for lenders to be fully aware of how their debt facilities rank in terms of seniority within the capital structure of the company to which they are lending. Lenders' rights under their debt facilities can be severely prejudiced via subordination to other lenders or third parties. This can occur in the following ways. Structural subordination. If a lender lends money within the company at a level far removed from the entities generating the cash and assets needed for repayment, the lender may be prejudiced by other suppliers or lenders closer to the cash generating entity. The creditors closer to the cash generating entity would be able to make direct claims to such an entity for repayment. If the lender, however, chose a company much higher in the group structure as its borrower, this borrower might only be able to access the cash from the cash generating entity via dividends or shareholder loans. These dividends or shareholder loans may be subordinated to the direct claims of the suppliers or lenders closer to the cash generating entity. Thus, even if the lender thought they were the most senior lenders to their borrower, there would be other third parties much closer to the cash generating entities. This would make them structurally more senior to the lender by virtue of their position in the company group structure. Contractual subordination. This would be achieved by legal agreement between the different funders in a company. These lenders would agree to which facilities would be paid from the first to last during the ordinary course of business and during a liquidation. It is important for new lenders to scrutinize all the existing financial arrangements within a new borrower, since legacy contracts may have been drafted to give existing lenders more seniority than new lenders, thus prejudicing the new lenders. Taking these issues into consideration, we can begin to structure a project financing transaction. The transaction diagram highlights a basic skeletal structure typical of a project financing. The ultimate sponsor is a listed company, listed co. It has numerous mining operations located around the world, each at various stages of the mining life cycle. The transaction in question is a $1.5 billion senior debt loan to develop one of Listed Co.'s South African assets, ABC Mining. The borrowing entity in this transaction is ABC Mining, and it is currently in construction phase. One of the major principles of structuring project financing transactions is to always lend as close as possible to the entity generating the cash flows needed to repay the debt. This usually gives the lenders greater control of the cash flows arising from these operations via the pledging of disbursement and proceeds accounts. It also simplifies the taking of security over the assets being financed. Typically, the lending consortium would be made up of more than one bank for the purposes of risk sharing. An underwriting bank, usually called an underwriter or mandated lead arranger, or MLA for short, would structure the loan facility solely with a client or sponsor. Once the terms of the loan are agreed, the underwriting bank would provide the full $1.5 billion loan to the borrower, and then subsequently try to sell down some of its $1.5 billion exposure to other banks in order to reduce its final hold position in the loan. This is called a sell down. The underwriter runs the risk that if the transaction it structured was not well suited to other banks in the market, from a risk reward standpoint, then other banks would not buy some of its exposure, leaving the underwriter stuck with a larger exposure than it initially envisaged holding. Underwriting and arranging roles carry lucrative fees. Hence, many banks are eager to take on such roles. From a sponsor's point of view, underwriting is very attractive as it reduces the number of banks the sponsor would have to negotiate with directly, thereby speeding up the funding process considerably. The sponsor now only needs to deal with one bank, the underwriter, who guarantees to provide it with a full $1.5 billion commitment it needed. The highlighted boxes in the structure diagram illustrate the companies in the structure that are most important from a security perspective. The lenders would require that these companies pledge their shares and other assets to a security SPV to be held for the benefit of the lenders. In the event that the project fails, these assets could then be liquidated in order to repay the debt. What do we mean by the entities that are most important from a security perspective? These would be the companies that regularly receive or disburse funds to other group companies. Companies that carry as much asset value as possible, and companies where the lenders understand the specific security nuances associated with their countries of incorporation. These companies in the structure diagram would be the borrower, ABC Mining. This company would own the assets being financed by the project financing, and these assets would form part of the lender's security package. The finance company, African Finance Co. This company directly owns the borrower and forms an intermediary link between the project company and the listed parent company. Intercompany distributions would usually flow between these companies. Typically, such intermediary companies would be domiciled in tax-friendly jurisdictions, Mauritius in the example below. Treasurers would make sure that the most efficient tax structures are chosen for their companies. Mining companies would move funds throughout their group structure using either dividends or shareholder loans. It would be important for lenders to capture every link of the chain of cash movement within the group in order to be able to enforce their rights in a default situation. For this reason, lenders would want security over the shares, shareholder loans, and other relevant assets of African Finance Co. Operation 1. This is an asset that is already in steady state production and is therefore generating cash. If possible, lenders would want security over cash generative assets as a way of de-risking the transaction. The trading company. This company would be structured to have an arm's length agreement in place with a borrower, whereby the finished product produced by the borrower would be sold to the trading company, who would then in turn market the finished product in the open market in order to secure the best offtake arrangements with external buyers. It would be important for the rights under such a marketing contract to be ceded to the lenders, in order to allow them to either cancel or take over the marketing of the finished product from the trading company if it was in their best interest to do so in an event of default. The boxes numbered 3 illustrate the guarantees that would need to be put in place in favor of the lenders. If the borrower, ABC Mining, was unable to make contractual repayments to the lenders, the guarantees would allow the lenders to demand repayment from other cash generative companies within the listed co group, in place of the borrower. Guarantees provide a cheaper and more efficient mechanism to ensure repayment than an outright liquidation of the borrower. Guarantees should be taken from companies that are cash generative to the best extent possible, and from companies in the direct cash flow chain from the borrower all the way to listed company level. In conclusion, it can be seen that guarantees and security were only taken on the most useful companies in the group. In practice, putting together a security package can be expensive, and thus lenders seek to put together the most comprehensive security package whilst incurring the least possible costs in order to do so.